Thank you for having me here today. And my name is Charmaine, and I'm a research analyst with FSM Global Research and Portfolio team based in Singapore. So today I'm happy to be here, and this is actually my first overseas business trip, and we are actually doing the same exact event in Singapore right now as well. Yeah. So without further ado, let's get to the main point of why am I here today? Singapore. So for years, Singapore equities have been known as one thing: a steady income generating market, a place where you place capital for the dividend and not for growth. And that reputation is well earned, but it is also increasingly incomplete. Today, I want to walk you through why we believe the Straits Time Index, STI, can reach 6,000 by 2028 and why that target is achievable on fundamentals alone without needing a re-rating story or a speculative narrative to get there. And this is Singapore evolving beyond dividends and not away from them. And for those who don't know, the STI is the equity market index for Singapore. It covers the top 30 largest companies by market cap in Singapore. So before I go any further, a quick note and just disclaimer that everything I share today is general market commentary. So before speak to a licensed advisor before acting on anything discussed here. So here's how I structure today's session. We'll start off by setting the scene and where does Singapore sits in a genuinely volatile global backdrop. And from there, we will look at the three key pillars supporting our investment thesis for Singapore, with banks anchoring the income and the dividends for the STI, and for industrials to drive the earnings growth potential for the STI, and also another key factor and tailwind that's driving for the Singapore market, and that is all the capital reforms initiative and capital revitalization initiative that's driving the market alive, such as our EQDP, small mid-cap space. And finally, we also go into our valuations and how we can get to that 6,000 target. Yeah. So if you can see on this slide over here, you can look at the regional markets and how this year have been quite volatile, especially if you have exposure to the memory chips, because South Korea and Taiwan this year have actually rallied quite a bit. And with Middle East tensions, shifting trade policies, and swings in AI sentiment, they have all moved markets in Korea, Taiwan, and Japan quite sharply. And Singapore has actually been quite resilient. And during the global bond yield spike and semiconductor sell-off recently, Singapore was actually one of the few markets that actually closed in the green. And that's quite rare. And you will price that premium for that volatility, and how most investors actually look to see Singapore as kind of like to kind of complement their more volatile plays, like all these semiconductors name or those AI tech names, because those are much more volatile, and Singapore is the one that's actually anchoring that with income as well as a bit of earnings growth potential as well. So you might wonder, why so? Why Singapore is so resilient? So the STI is actually meaningfully less tech heavy than the Kospi, TAIEX, or even the Nikkei 225. And that sectoral composition, historically seen as a weakness, has actually worked in Singapore's favor this year. So when AI-linked names swing hard on sentiment, Singapore's banks and industrials, businesses with real order books and real earnings, do not swing with them. And the numbers actually back this up. So the STIs has actually delivered close to 14.5% year to date. As of yesterday, it's about 16% now. Yeah, so that actually outperforms several regional peers, and in a year where the backdrop has genuinely been quite uncertain, and we maintain a 4 stars very attractive rating on the Singapore equities. And here is the key shift I want you to hold on to for the rest of the talk. So the drivers of that performance are no longer just defensive. AI-driven export growth, safe haven wealth inflows, and capital market revitalization are now complementing the traditional income characteristics investors have always come to Singapore for. And that's the thesis in one sentence. So Singapore is also adding growth engines on top of its income engine, not replacing one with another. So we move on to our first pillar, which is on the banks. So all three Singapore banks actually beat expectation in the first quarter of this year, with DBS and OCBC reporting record total income. And combined non-interest income across the three banks have actually hit SGD 5.16 billion, and which is a record, up from SGD 4.78 billion a year earlier. And what's driving that is a real shift in earnings mix. So fee income, trading, and wealth management are emerging as the sector's primary growth engine as net interest margins stabilize. And DBS annualized ROE of around 16% is the highest among the three banks, and asset quality across the sector remains sound. And that combination actually gives us confidence that the earnings base is durable enough to support a much bigger story I want to spend the next few minutes on, and that's on wealth. So Singapore's position as a global wealth hub has actually strengthened at an accelerating pace this year. And I think this is genuinely underappreciated outside of Singapore. The escalation of conflict in the Middle East has actually disrupted the calculus for Dubai's large expat wealth community. And Singapore's, with its safe haven reputation, is a direct beneficiary. Gold imports from the UAE have grew 4 times since January, and OCBC has also reported rising net wealth inflows, specifically from Dubai as well. And Singapore has now been ranked the world's most expensive city for high net worth individuals for the 4th year running, according to a Julius Baer Global Wealth and Lifestyle Report. And that is not just a coincidence. It actually reflects sustained capital and demand concentrating in one place. And actually, MAS also took note of this and is actually reinforcing this momentum and not just riding it. So on the 25th of May this year, MAS actually announced that it is working to cut private banking account opening times to within just 1 month by the end of this year, down from 6 or more weeks today for complex cases. And importantly, this is risk appropriate and not just looser standards. Banks actually assess the source of wealth more efficiently, while anti-money laundering AML safeguards stay fully intact. And faster onboarding actually shortens the gap between client acquisition and fee generating asset deployment. And that flows straight through to the non-interest income growth I have just shown you. So the banks are also not just waiting for this demand. They are actually building capacity for it right now. DBS announced its largest ever physical wealth expansion, 18 new and 36 upgraded wealth centers across Singapore, Hong Kong, China, India, Indonesia, and Taiwan by the end of 2027. And the first new Singapore center actually opens in the 3rd quarter of this year, which is and also shown a 50% increase in local footprint. And why does physical space still matter in a digital age? Because more than 40% of high net worth clients in Singapore and Hong Kong still prefer face-to-face relationship management. And that's a real durable competitive moat. And OCBC is taking a different but complementary approach, sharpening segmentation across ultra high net worth clients with at least a USD 100 million in assets, and integrating Bank of Singapore consumer banking and Great Eastern under one strategy they now call the Next Frontier, targeting a 30% increase in ultra high net worth AUM contribution by 2028. And we read this capacity build out as the clearest signal available that banks that themselves actually believe that these wealth inflows are structural and not short-lived event-driven spike. And our positive stance on the sector stands. And DBS actually stands as our top pick on its private banking franchise, its regional wealth platform, and the highest forward dividend yield among the three banks. And now let's turn to our second pillar, the growth engine, which is the industrial sector. And I believe that this sector that is quietly becoming the second largest weighting in the STI, actually overtaking the S-REITs this year. And two names actually anchor this story. So ST Engineering order book actually sits at a record SGD 34.5 billion as of 1st quarter of this year. And defense and smart city contracts are at all-time highs. And Yangtze Shipbuilding order books also stands at USD 22.3 billion, with 252 vessels contracted through 2030. And both of these actually give multi-year earnings visibility that is structurally different from earnings that is tied to the interest rate cycle. And I want to spend a moment on each because I think the depth of these order books is genuinely underappreciated. So ST Engineering actually secured SGD 18.7 billion in total contract wins last year, which is a record and up almost 50% year on year. And this is actually spread across all three business segments: commercial aerospace, defense and public security, and urban solutions. And that diversification actually matters. It spreads earnings across aviation recovery, global defense spending, and government digitalization demand. And so no single cycle can derail the group. And defense and public securities actually led the growth. And earnings before income and tax actually is up 14% year on year to SGD $725 million, powered by new market entry into Qatar and an expanded Middle East naval footprint. And at home in Singapore, the group actually keeps winning strategic government work, including next generation Harrex infantry vehicles for the Singapore's Ministry of Defence. And critically, SGD 9.9 billion of that order book is already expected to convert into 2026 revenue. And international defense contract wins actually doubled year on year last year, and management has guided to repeat that again this year. And this is about to as close as lock in multiple year earnings visibility as you will find on the exchange. And Yang Zhejiang actually tells a different but equally compelling story. So the global shift towards green shipping. So 69% of its order book by value is now clean energy vessels, LNG and methanol dual fuel ships, and gas carriers, reflecting a real structural shift in global shipping demand as the industry decarbonizes. And that order book actually stands at a record USD 22.3 billion as of May 2026, with revenue visibility extending through 2029 and beyond. And management has also reaffirmed a USD 4.5 billion new order target for this year. And the mix keeps moving towards higher spec, higher margin vessels, container shipping line, and that line alone has also ordered 12 dual fuel container ship from the yacht. And margins have actually held up well too. So markets forecast a shipbuilding gross margin near 34% for this year, and this is actually still well above its mid 20% seen just 2 years ago. And the balance sheet also supports both growth and shareholders' return with a net cash position and with dividend yield near 5.8% as well. And they also have a proposed 10% stake in Poseidon Corp, and that will actually also help to deepen customer relationship further. And that brings us to our third pillar. And honestly, it's the one that I find the most exciting to talk about: revitalization. So for those people who don't know about this, this is something that was announced recently. And yeah, so before we get to the capital flows, I want to flag two structural reforms that are quietly lowering the barrier to entry for everyone in this room. So from the 5th October of this year, the standard board lot size for securities priced above $10 is being cut from 100 shares to 10 shares. So for those stocks that could benefit from those, as you can see over there, are like DBS, OCBC, UOB, Keppel, and SGX. Those are the larger caps. And this initial phase for these reforms actually covers 11 counters. And these names actually form up roughly 35% of the first half 2026 trading activity this year. And from the 15th of July, a new post-trade custody model actually allows depository agents to hold SGX-listed securities through broker custody accounts, aligning Singapore with international settlement practice. And neither of these actually changes the underlying investment case. And what they do is they lower the friction for retail and institutional investors alike to actually act on that case. And that matters more than it sounds, because friction is often the real reason capital sits on the sidelines. And now onto the capital itself. And the single policy initiative I think has done the most to change Singapore's market structure this year is actually the Equity Market Development Program, or EQTP in short. And this was actually launched in February last year with an initial SGD 5 billion allocation. And now it is actually SGD 6.5 billion with additional funding from the Financial Sector Development Fund announced earlier this year during the budget announcement. And EQTP actually channels institutional capital into Singapore-focused equity strategies. And SGD 3.9 billion has actually been placed to date and across 9 appointed asset managers, with about SGD 2.6 billion still available for deployment in the second half of this year. And a third batch of asset managers is expected in the coming weeks. And the results of this initiative have already been visible in market data. Securities daily average value actually grew 79% year on year to around SGD $2.4 billion in May 2026. And this is the highest level since October 2007. And IPO proceeds raised last year actually also hit SGD $3 billion, ranking SGX first in Southeast Asia. And the market is also on track this year to hit 20 to 30 listing, building on that 16 last year. And net foreign inflows actually reached USD 2.3 billion in 2025, among the strongest years of net buying since 2010. And this is not a temporary sugar rush. It's a deliberate, funded, multi-year program designed to permanently deepen Singapore's capital market. And that depth is showing up exactly where you want it to be, in the small and mid-cap space, where liquidity has historically been the biggest complaint about Singapore. So average daily turnover for existing small and mid-cap actually rose 83% between the first half of last year and the first half of this year, from SGD 362 million to 663 million, comfortably outpacing share price gains. And that's an important distinction. This is liquidity deepening, not just re-rating. And across that 240 small mid-cap names, a combined average daily turnover actually reached SGD $696 million in the first half of this year, with an average total return of about 13% across the cohort. And institutional inflows into small mid-cap tech names alone actually reached SGD 560 million. And the strongest inflows relative to market cap actually went to names like AEM and Franken. And AEM itself is a great illustration of what's happening. Average daily volume actually rose from 2.9 million shares to 6.6 million shares over the past year, as its share price climbed from less than $2 to more than $10. And this isn't a narrow rally either. So participation is actually genuinely broadening across both institutional and retail investors. The STI actually hit a record intraday high on 9 July 2026, the day that I submitted this slide deck. And June alone actually saw SGD 611 million in net institutional inflows, reversing more than 40% of the prior 5 months outflows. And financial services led that buying. SGD $683 million across UOB, OCBC, DBS, as well as SGX. And for the first half overall, tech and industrials attracted the strongest institutional inflows, underpinned by AI, semiconductor, and infrastructure themes, exactly like the ones that I just walked you through. And retail is actually showing up too. STI ETF net inflows have now run for 15 consecutive months since March 2025, with combined AUM reaching SGD $4.7 billion. And when you see institutional and retail capital spread across banks, capital market names, and structural growth sector all moving in the same direction at the same time, that's not a single team rally, that's a market-wide re-rating. And also one more thread into this before we get to valuation, because within the small mid-cap space, that is where you see many semiconductor names. And May's non-oil domestic export NODX growth actually came in at 38.4% year-on-year, the fastest pace since December 2003, extending a 9-month growth streak and beating consensus by a wide margin. And electronics exports nearly doubled, up close to 100% on integrated circuits, this media, and PC demand. And this isn't abstract. Applied Materials actually opened a USD 500 million campus in Tampines in June, more than doubling its advanced clean room capacity in Singapore. And Micron, high bandwidth memory chip packaging facility, and NVIDIA first Singapore research hub actually anchor the demand well into 2027 and beyond. And Singapore is now not just a financial center, it is becoming a physical node in the global AI hardware build-out. And that shows up directly in the earnings of the names most of you have probably never really looked at closely. And 3 names at here actually gives investors direct exposure to this: UMS Integration, AEM Holdings, and Franken Group. So in the first quarter of this year, UMS grew revenue 20% year-on-year and net profit up 43% year-on-year on demand from Lam Research as well as Applied Materials. And AEM's growth was even sharper. Revenue is up 36% year-on-year and net profit is up more than 300% this year, driven by Intel demand. And its share price is up over 500% for the first half of this year. And Franken also saw its revenue ease 6.4% as softer European demand in its analytical life sciences and EUV related segments. Though its Asia semiconductor business actually grew robustly, and management actually guides for a second half recovery. And all three over here are direct beneficiaries of Singapore's structural AI semiconductor upcycle. And all three here actually qualify under the EQDP program I described earlier, but they differ meaningfully on customer concentration, valuation, and growth durability. So let me give you our view on how we differentiate between them. So over here, AEM actually has the strongest growth story because they have a new ASE technology partnership and a market opportunity growing from USD 3 billion to USD $4.5 billion by 2028. But a rally of over 500% in the first half of this year actually leaves very little room for execution missteps. And on the other hand, Franken is the most defensive because of its customer base. They are more diversified across semiconductor, medical, and automotive end markets. And also with a new Singapore facility completing in the first quarter of 2027, that could also help to build up more capacity and also drive further revenue numbers. And however, in terms of margin, it is actually still not as strong as AEM or even UMS. In this space, our current preferred pick is actually UMS integration, and they are actually benefiting from both applied materials and Lam Research demand, alongside genuine Asia supply chain diversification. And customer concentration historically actually make up roughly 80% of revenue comes from applied materials, thus warrant some form of position sizing discipline. But the risk reward here is the most compelling among these three. And for everyone in this room specifically, this name might be familiar to some, since UMS integration actually carries a secondary listing right here on Bursa Malaysia. So let's bring this all together with valuation. So where that leaves us. So we maintain our STI target to roughly 6,000 by 2028, which is around 14% upside from current levels, alongside an annual dividend yield of approximately 4.5%. That means more than 20% total return. And I want to be precise about how we get there because this is the core of today's title. We are not underwriting a re-rating story. We are not assuming multiples expand because sentiment improves. In fact, this target over here is actually derived from just earnings growth alone and not through multiple expansion. And these targets actually rest on the three pillars I've walked you through today: income resilience from the banks, earnings growth leadership from industrials and the AI supply chain, and a broadening opportunity set from the capital market revitalization. And each of those is actually grounded in contracted order books, disclosed capital programs, and reported earnings, not in a story about what Singapore could become. And that combination with meaningful dividend yield and genuine capital upside is genuinely rare among developed markets today. Where else can you find a developed market that has such attractive dividend yield alongside price upside? And Singapore actually offers it with less volatility than tech-heavier markets like South Korea or Taiwan, which is precisely the comparison we open with. And Singapore has actually spent decades earning its reputation as a defensive income-generating market. And that reputation was never wrong. It was just incomplete. And what we have shown you today is a market quietly building a second engine, growth. Alongside the income, it has always delivered. And that is evolution beyond dividends. And it is why we believe 6,000 by 2028 is not a stretch target. It's a base case. And thank you so much for today, for this afternoon. And my team's contact details alongside, with our general and market inquiries line are on the screen if you'd like to follow up on anything from today. But for any questions, we will take it in the panel discussion, the upcoming panel discussion.